Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Devendra Kumar Pant, Chief Economist at India Ratings and Research, joining in. Welcome to the show, Mr. Pant, and always a pleasure
Yep.
to speak to you and get insights from you.
Yeah.
Mr. Pant, my first question coming to you is, overall, what's your take with regards to where the budget announcement goes? Because clearly, one, it has been capex heavy, and two, the comments that we hear is it is a growth oriented budget, but not a populist one, even though it's just ahead of the elections.
Well, Hiral, it depends how you define the populist measure, right? Now there are for same problem there are different solutions, be it medicine or be it economics or politics. Now, what we were looking at, everybody was looking at a couple of things. So everybody was expecting fiscal deficit to be higher, but nobody expected 6.4. Everybody expected expenditure to either increase or remain almost similar to what it was, what it is going to be this fiscal. And everybody was expecting that your taxes, there will be no new taxes. Rather, people were expecting or hoping for some reduction in tax rates, especially for quote unquote the middle class. All these things were legitimate. So if you are not expecting expenditure to go down, you are not expecting tax rates to go up, deficit to remain high, the market borrowing, but natural are going to remain high. But since nobody was expecting 6.4, so 14.9 trillion of gross borrowing was a big shocker to the market. Now, if you look at what was everybody was looking at, there's some sort of demand booster to the economy. Now, how the demand booster can come? One way of demand booster is you transfer some money to the people at the bottom of the pyramid, those people who have marginal propensity to consume closer to one. So basically, whatever they get, additional money they'll get, they will consume, and that way will money come back in the system. Demand will rise. Higher demand means the capacity utilization, which we are looking at somewhere around 60% may inch up, and once demand remains stable, then your capex will start taking place. Rather than that, the government had decided to take a different route. So that is route which government has opted for is the capex-led route. Okay, let's increase the capex. So increasing capex, now if you compare from BE to BE, it is 35.4%. You compare RE to BE, it is 24.5%. Nonetheless, it's a huge increase from 6 lakh crore to somewhere around 7.5 lakh crore. Interestingly, or one good thing which has happened in this is because the states are closer to the people, and most of the development expenditure in this economy is done by the state governments. Central government or the union government generally spend more amount on the non-development expenditure, that is basically interest payment, etc., etc. But when you talk about health, education, rural development, irrigation, flood control, etc., etc., these expenditures are done by the state governments and giving 1 lakh crore, 1,11,000 crore for 50 years to the state, which will help them to take capital expenditure or the capex is a good sign. Bigger question is how quickly this capex will lead to increased capacity utilization, increase some amount of push to the employment, and through that the consumption. That only time will tell. As of now, it's very difficult to say that this 7.5 lakh crore amount will lead to what level will of increase in employment and the extent of demand generation in the economy.
Correct. Absolutely. And I think execution is going to be key. So would it be right to say, Mr. Pant, that the budget has actually captured transition from a time of pandemic to one that cautiously pulls back support and then seeks to transition the economy to a stable and potentially higher growth path? Is that the way to look at it?
It is trying to do it, but somewhere I feel is if some push to the demand, direct push to the demand was given, So when I'm saying that direct push to the demand, it was not to the income tax relief to people like you and me, those who are part of this program or those who are listening, but the people at the, again repeating, bottom of the pyramid. Because what we say, I think couple of years back, the economic survey by Arvind Subramanian talked about JAM, Jan Dhan, Aadhaar, and Mobile Trinity. And that is how we will be able to Jan Dhan, Aadhaar, and mobile, and that is how we will be able to transfer money to or the in-government intervention. If something of that sort was done, so it is should like if it was done a mix of capex and some demand booster. So what happens by the time capex led demand boost starts coming to the system, you have some amount of demand boost which are coming directly, and gradually you withdraw that direct demand boost and let capex led demand boost giving benefit to the economy. But at the end of the day, you have to give that prerogative to the government about their thinking and what they are thinking the best for the economy.
Right. And overall, clearly, as you mentioned, it's more from the point of view of investments, whereas there has been no impetus that has been paid with regards to where consumption support goes. Do you think that has come in at the cost of a slower path to fiscal consolidation?
Look, Hiral, as I said in the beginning, if we were expecting expenditure to remain high, taxes not to be raised, the fiscal consolidation path, and we were expecting, and most of the people were expecting the fiscal consolidation path will be pretty slow. That's a different thing. People were more towards 6%. Government has opted for 6.4%, 50 bips correction. And even in this fiscal, when we are looking at a huge boost or to the taxes, rather than reducing the fiscal deficit, government had decided to expand it by another 10 bips. So fiscal will be a long drawn process. The debt market, unfortunately, the bond market has to bear it for a few more years. Now, whether it's few more is 2 years, 3 years, 5 years, it only time will tell. Because based on what is the situation in and around us, whether domestic or the global, it is unlikely that the economy will come back to high growth path for a longer period very soon. It will do a gradual catching up, because next year, because first quarter of this fiscal was weak, so that will have some kind of base effect. But in long run, in medium run, as of now, expecting 6.5% to percent or more, 6.5 to 7% growth in the medium term is very unlikely. What it is happening is this year it had happened. It will continue in most part of the next year. Is the inflation tax which people or the citizens are paying, because the inflation is way too high, and what taxes we pay, whether direct or indirect taxes, is on the nominal or the current values. So in a situation you have 8% real growth and you have 5% inflation, you will get 13% plus, because it was 1.08 into 1.05, not the addition of 8 plus 5. So somewhere around 13.1 or 13.2% nominal GDP growth. There could be another combination where you have the 10% real growth and only 3% inflation. Now, it is likely to give same amount of taxes because the nominal growth is going to remain 13%, but 10% real and 3% inflation is a more desirable outcome than 8 plus 5. So the inflation tax will continue in the next year also. Fiscal consolidation will be long, drawn out, slow process, maybe 50 bips, 40 bips here and there each year. And unless you're interested in the market or the economy, is likely to remain at an elevated level.
Right. So when you talk about growth also at 8.5% as to what the economic survey is pegging it to be for FY23, how achievable is that number going to be? Because behind the conservative estimate for the next year, not just the many risks like global inflation to shortage of inputs that have been posed by COVID-19, but also its assessment that the economic slowdown induced by the pandemic is not merely a demand problem.
So we our estimate before the budget was for FY23 was 7.6% for the for FY23. Naturally, the capex boost which has come to the system, or the revenue expenditure boost which is there in the system, that is going to give some add some delta to 7.6%, but 8% as on today, with the kind of withdrawal from the ultra loose monetary policy by the global central banks, the elevated commodity prices, oil at somewhere around 80 to 90, though it is said that 18 months back it was $20 a barrel. So it is not sure that 6 months from now it will be even $40 a barrel or $70 a barrel. It could be $200 a barrel, it could be $5 a barrel. It will depend on how the global demand and supply situation pans out. So to us, it appears that the growth will be somewhere lower than the lower bound of that 8%. It is unlikely that 8% real with these kind of this kind of situation, domestic and the global macros, it is very difficult to achieve.
Right. And overall, what's the kind of direction are you expecting the RBI to take as well? Because clearly, are we expecting that there could be a change in stance? What are the kind of rate hikes that could be on the annual? Now taking into consideration what the projections look like by the government.
Look, we were expecting that government will undershoot their fiscal deficit this year. So we were looking at a number of 6.6% for FY22, and we were looking at a number of between around 6% in FY23. With these, we were looking at a market borrowing of 12.4 trillion gross and 9.4, I think, for the net market borrowing. Now with this kind of deficit trends, we were more hopeful that the RBI will continue to have its monetary stance, at least in this particular policy. But it is more likely that if we see the way the short-term interest rate in the economy, whether we look at the T-bill rate or call money rate, they have started either they have started breaching the repo corridor on the upside. Gone is the situation when some of the corporates were doing 90-day CP rate below the reverse repo rate. So the liquidity condition is gradually tightening. So I think rather than any point estimate whether what is going to happen next week or so, it is more expected that RBI will likely to move away from this accommodative stance at the ultra low, may go first move to the neutral. And then from there, depending on, again, most of these things will be more data dependent. What happens to the 6 big central banks of the world? So what happens? DOJ, BOE, ECB, PBOC, Swiss Bank, and Fed. In fact, Chinese PBOC has cut short-term interest rate a couple of weeks back. So the more likely that stance is moving, going away from the accommodative to neutral, and may see a couple of rate hikes, maybe 25 to 50 pips in the next fiscal year. But when it will take place, it will be more data dependent. But if one looks at and factors in Dr. Michael Patra's statement a week back, that gives an impression that it is unlikely that there will be any rate hike in the coming fiscal also, or the probability of rate hike in next fiscal is also low if one goes by Dr. Patra's statement.
Right. And to add to this as well, overall, in terms of the divestment target as well, Mr. Pan, they've reduced the number in terms of FY22. 65,000 crores is what they've said in terms of FY23 versus the street expecting, say, around 1.2 to 1.3 lakh crores. How doable is 65,000 crores as well? Because clearly, always there is a major disappointment in terms of divestment, when the budget announcements are made versus what is really achieved.
Look, Hiral, I think what strategy the government is following is, in certain places to keep some sort of buffer. So that, because if I look at the revenue expenditure estimate, they are too optimistic, because if I look at non-interest revenue expenditure, that is hardly growing. In fact, that is contracting. And if I look at non-tax revenue, non-tax revenue is from dividend and dividend income, which was 50,000 crore budgeted 46,000 and posted to decline to 40,000 crore. So there are some places where government has kept up some buffer, but one way is to overpromise and underachieve, and you underpromise and overachieve. Because it is not all said and done, it is not very easy to do the divestment or privatization in this country. It is extremely difficult. Governments after governments have failed to achieve disinvestment target 1 year after year. So 1 year or 2 years they will achieve, but regularly they are not able to achieve. The present government was able to achieve it in past few years, but it is not. Now, if I look at the FMS said yesterday that LIC IPO is coming this year, all right, and so whether that IPO will succeed this year or whether they will file it and it will do next year. But if you look at in past, the 40-50,000 crore worth of disinvestment is one number which they are able to, different governments are able to achieve. I think they may be depending upon if the equity markets remains the way they are, and they are able to like they were able to sell out Air India, whichever way, because I'm not a valuer, I will not go into detail whether they have undersold it or oversold it, whatever, but they are able to sell it. So the loss minimization has been done. Then we are talking about shipping corporation, BPCL, etc. Most of them are profitable companies. It will not be very difficult to find a buyer for them, unless government is able to take care of internal labor issues or the labor or the union's demand. And if they are able to take care of that, then I think 68,000 or 65,000 crore worth of disinvestment will not be a problem, and they may overachieve some amount there, so that if there's the requirement, say for example, Manrega is under provided, same as what was there in this year's BE. And if you are saying the rural stress, then the Manrega may need more money. And that is one sector where they can't deny, they can't postpone, the money has to be provided. So I think that 68,000 may going up to 70-75 if they are able to do it properly. So as you said, and most of the people are saying, execution is the key in entire budget arithmetic.
Right. And very lastly, Mr. Pant, overall, what's the impact that we could see in terms of the rupee and the bond yields?
Okay, so the bond yields are likely to go up, and more than the demand and supply of paper in the market. I look at it more from the fundamentals. So if you look at the savings rate in the economy, that is coming down. Day before yesterday, government released first revised estimate of FY21 macro aggregates. And if you look at savings have come down in FY21 from FY20. Now, both because lower GDP or contraction in FY21, households have, because they were not able to spend, there is some increase in household savings. But if you look at the trend over past few years, the households are the only economic institution in this country, those who have the surplus savings. So they save more than what they invest. And their surplus savings are used by other three institutions, that is general government, public sector, and the private sector. Now, unfortunately, what has happened, all MSMEs are part of this household group. So all unregistered, unorganized entities are there. This group is in this particular group is under stress from last 4 or 5 years. Unless we remove stress on that of this sector, it is difficult for savings to come increase. Now, if we take the the net household savings, right, that is falling, and look at just the government demand. So when I say government demand, I'm looking at central government, state government. It is very difficult to get state public sector enterprises data. But if you look at the central public sector enterprise data and combine their net borrowing requirement. So household savings, net household financial savings were 38% higher than the demand of the government, net demand by the government in around FY 17-18. But we haven't worked on FY21 number, but by FY20 that had come down to just 11% higher. So that curve is tapering downward.
Correct.
Now, if this trend of declining household savings and rising demand continues, then it may be a situation couple of years down the line where both curves will meet, or either the net household financial savings will be lower than the government requirement. And that is the one thing which is keeping this pressure on the bond yields. And the bond yields are expected to move up from here. They may remain around 7. They may inch up. That will all depend on in between if government change some policy measures.
Absolutely. So overall, a lot of factors we need to watch out for. Thank you, Mr. Pant, so much for joining us on the show. It's always a pleasure to speak to you and get insights. Thank you. Stay safe and take care, and speak to you soon again.
Thank you. Welcome. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.